We started financial planning for Canadians with showing you how to create a budget, how to add more money to your cash flow, and we start with our goals and concerns. Now, once we have those goals and concerns, once we have that cash flow, we do need to talk about something else in the plan that's very important to our long-term goals especially, which is our investments. Here in Canada, there's some traditional investments, and we're going to talk about them today, and I'll give some insight onto each one and where they kind of play into a plan for each one of you. My name's Aaron. We have our coffee. This is Cozy Financial Planning. Let's get right into the video. We have our 4 traditional investments we're going to talk about today, and we're going to get right into them. I'm going to give a little bit of insight as a financial advisor on where you can put them into a plan after each one as well. But we're just going to talk about the broad strokes of them, keep it really basic for you, and then go from there. If you have any questions, comments, always please leave them or send me a DM. We'll talk from there. Now, the first one we'll talk about is guaranteed investment certificates, GICs. These are very simple, very straightforward, and they're very safe. So what happens is you give your money to an institution, such as a bank, for a set period of time, 1, 3, 5 years, something like that, and then they're gonna guarantee you your principal back and interest at the end of the term. So as an example, if you've got a 4% interest rate and deposited $1,000 into a GIC for 1 year, you'd end up with, at the end of the year, $1,040, right? Pretty straightforward, pretty simple. Now the key features of it are it's very safe because you get your principal back guaranteed. It's low risk, and often it can be insured as well, so it's really, really safe. Now there is a low return with it, but that, as an advisor, I used to always tell people that's kind of the payment you make for making the guarantee, is you give up that high-end potential return, and you end up with something just safe, right? Now, what I would use these for people are very short-term goals, less than 5 years. As a retiree, you may want to do some of these because you want to keep money safe, because you need the actual money to pay for your retirement now. You're not really trying to build wealth at that point. Or you may just not be able to handle the risk. So you do something like this. And if you are retiring, or you want to do something a little more mixed, so it's not all chunked out at one time for the period of time you have it, is I would do something like a ladder. So you do you take a third of your money, put it in 1 year, another third for 3 years, another third for 5 years if you want it, something like that. Also, you'll get differing amounts of interest because you hold it for a longer period of time. They'll give you a little bit more interest. So that's kind of brings us to the end of what a GIC is. Next up is something kind of similar. It's kind of a mix of investments, is a bond. Now, a bond is something where you're essentially loaning money to an organization, government, or a corporation, because there's different various types of bonds. We're not going to go into the minutia of those today, because you get lost in the weeds a little bit, but we'll keep it pretty simple. But yes, there's multiple different types as an organization. Now, what happens here is these can be longer than a GIC. These can be upwards of 5-10 years. And what happens with the bond is they're going to pay you an interest after every set period of time, every year usually. Sometimes a little shorter. You can get paid interest every 6 months. But for an example is, let's say you have a 3% interest rate and you invest $1,000 in a bond, Government of Canada bond. You can get back $30 every year on your anniversary date. So at the end of the 5-year period, you'll get your $1,000 and an additional $150 in interest accumulated over the whole 5 years, paid out every year. So the key features of this are that it's low risk. Usually, especially government bonds are really low risk. Low interest rate, though, for the most part. It can fluctuate, and they're relatively safe. Now, one interesting thing about bonds, a pro tip on that, is you can trade bonds or sell them on the open market. It does depend on the interest rates for what they are, and not to get too into it, but essentially they have an inverse reaction to the interest rate the way it is. So if the interest rates go up, your bond is going to go down in value on the secondary market. And that is simply because if the interest rate's up, I can get a higher bond if I just buy it brand new than buying yours that was given to you 2 years ago at a lower rate. Makes sense? These are something I would use if you're a little more risky than GICs, you have a little bit more longer term, and you want something that has a little more fluctuation and maybe capitalize on a little bit of growth or potential trades. We go into the next one, which is a mutual fund. These get a little more risky. They vary from pretty low risk to high risk. What a mutual fund is you're going to give your money to an organization and buy a unit or a share of it, and they're going to invest it for you. Instead of picking your individual stocks, they're going to make a diversified basket for you. One of the things about mutual funds is that it's a pool of money with other investors. So instead of it being your stock and just relying on the one stock going up or down, you now have access to a lot of different companies and a little bits of them, because you've now pooled yourself with a bunch of other investors and bought into a larger kind of share, right? Now, you still get your interest or dividends or capital gains if necessary. It is professionally management, so their downside is maybe there's a little bit of a fee to it compared to the GICs and bonds. There's usually not, or maybe at the sale there might be one for the bond. They're not guaranteed because the money can go up and it can go down depending on how the companies inside the mutual fund work. And then they're easy to buy and sell. You call your broker and it's usually done by 24 hours, right? Now, the other part about it is if you put your money in and they can go up and down. That brings us to the end of what a mutual fund is for the most part. Again, they can fluctuate up and down. So what you would do with these in a plan is you would set this out for longer term plans. I wouldn't put anyone in mutual funds for the most part if they're under 5 years for a goal. Even if it's a safe one, even if it goes down by $100, $300, right? Let's say you're looking for a down payment of your home and you need $10,000 at the end of 5 years. You don't want to put your money in the mutual fund because what if it goes down to $9,500? That's only 5% drop. It's not a crazy amount, but you'll feel it when you need $10,000 for your house and you're only $9,500. You have to come up with an extra $500. I would use something like this for long term, like RESPs, RRSPs, tax-free saved, longer term growth, as well as if you can handle a little bit more risk. You can use low risk mutual funds if you are a little more conservative, and you can have a mix of bonds and GICs in them, or income producing assets. Anyway, we're getting to the weeds of that, and so we'll move on to the last traditional investment, which are stocks, individually picked stocks. Everyone kind of has an idea of what this is you're buying an individual piece of a company, a publicly traded company, like a bank here in Canada. And depending on how their bank does every year, that stock is going to go up in value or decrease in value. You can get capital gains when you sell it, but you can get dividends off of it depending if the company pays out dividends or not. The problem with this is it's not diversified like the mutual fund. You're not buying lots of different companies in there. You're buying one specific company, so you're 100% in that risk. Stocks generally tend to be a higher risk choice. Even if you feel it's a safe company, it can still be a higher risk compared to mutual funds, GICs, or bonds. But the rate of return can be astronomically better. You know, if you bought Netflix or Amazon way back in the day, you'd be sitting pretty, probably retired by now and not paying attention to this video. But those types of things are possible with stocks, right? Again, they're not professionally managed like mutual funds. There's not really any fees other than the buy or the sell usually. So it's a little different. You do have to manage them. Now, where I'd put them into a plan for someone would be someone who can handle a bit more risk, a little more sophisticated, who maybe have a little more time if they want to watch things. And more important is they have the money to diversify themselves with a portfolio so they're not stuck in just one type of business. Again, this would be a longer term set, not something you'd want to necessarily do on the short term or retirement. You don't want all your money in stocks because again, the fluctuation means that your income for your retirement paycheck will be stifled or possibly slowed or less than you need when you need it. I hope this brings some clarity to you regarding traditional investments here in Canada. We talked about the guaranteed investment certificate, GICs, bonds, mutual funds, and stocks. If you have any questions or is there something you want me to cover specifically, please leave a like or a comment and hit the notification bell so you can be up to date on all our videos. Thanks for watching, and we'll catch you in the next one.